Hi everyone, welcome to my channel Stock Analysis 365. This channel is not just for earning professionals but for everyone, ranging from college students to retirees. In today's video, we are going to see why it is important for everyone to invest in the stock markets. You might have heard of this famous Warren Buffett quote: if you don't find a way to make money while you sleep, you'll have to work until you die. You will agree to this quote after I give you three solid reasons in my video. So let's not waste time and continue on with the good things. Firstly, you can rise from lower middle class to middle class if you get a good education and a job afterwards. But you can never become rich with this. You'll understand this more after you listen to my remaining reasons. Say suppose you earn a decent amount of salary from your day-to-day job. In the ideal case, if you decide to save only 10,000 per month after you cover up all your expenses, going by the today's interest rate offered by most of the banks on savings or FD, which is around 4.4 to 6.25% roughly, you will end up with somewhere around 52 to 68 lakh rupees by the time you are 50. Now, the real figure comes into picture if you consider the inflation rate, which is roughly 7.7% today. And even if you imagine it to be constant for the rest of your life, your 52 lakhs will be equivalent to just 20 lakhs by the time you're 50. So, in order to beat this inflation, you can either invest in gold, mutual funds, or stock markets, which is nothing but if you buy shares of good companies and hold them for a longer amount of time. Now, let me tell you why I chose to invest in equity instead of gold and mutual funds. The below charts clearly shows the kind of return gold and Nifty have been generating since 2006. There were only three occasions, that is in 2008, 2010, and 2011, when gold has significantly beaten Nifty on a yearly basis. Looking at this trend, gold doesn't seem to be a great investment avenue for investors. And now let me tell you why I chose equities over mutual funds. Because equities give a better return than mutual funds, and the rewarding potential is higher for equities. Moreover, though equities are riskier than mutual funds, you have greater control over them as you have the option to pick your own stocks. Now, coming to the main point of this video, if you invest 10,000 monthly in Nifty 50, which is up 14 times since its inception and has delivered an annual growth rate of 11.1%, you'll be able to save around 1.6 crores by the time you're 50. As you can see, this is much better at beating the inflation as the stocks factor in inflations when they grow. When I started this video, I said this channel is not just for earning professionals, but for everyone, ranging from students to retirees. Now, from these charts, we can clearly see that if you save some amount of money during your college days and say start investing but at the same age as before, that is 25 years, you would end up having more 30 lakhs by the time you're 50. And for retirees, I would like to give the example of Anne Schreiber from USA. She retired at the age of 51 and started investing just by putting $5,000. And by her final days, her net worth was $22 million, which she donated in entirety. So as they say, it's never too late to start anything, including investing. And tune into my channel for further such videos wherein I'll cover why I chose Nifty 50 over the Sensex. And not to forget, do like, share, and subscribe for more such videos.